just common sense would tell you that's how people operate,
Yeah, absolutely.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault. My name is Shane Moran, and I'll be your host for this episode. And from the entire Live from the Vault team worldwide, we want to thank you for your continued support. And as you can imagine, the community keeps growing more and more every single week, and there's a lot to talk about during these historic times. And Andrew Maguire is in the house with our first-time guest, Mr. John Ryan, CEO and president of a multi-asset resource company called Gold Express Mines. And we'll be talking gold. So this is going to be an amazing episode. You won't want to miss any of it. So, Live from the Vault gives you access to information and updates that you just can't get anywhere else. And this episode is going to be no exception. And just before we go to talking gold with Andrew Maguire and our special guest, John Ryan, we want to hear from you, the Live from the Vault community, on who you'd love to see as a special guest on this show. So to have your say, just go to the description below, head over to our Twitter, and then just tweet and tag your dream Live from the Vault guest, and we'll be keeping a close eye on that. So with that, let me introduce our special guest today. John has over 25 years of experience in the natural resources industry during this time, and he's got a business partner, by the way. His name is Howard Crosby, and they successfully founded and they developed and grew multiple companies from the startup phase to public listings, strategic buyouts, and asset sales. And in 2019, the pair founded Gold Express Mines, a junior mining company that owns and operates more than a dozen properties in 5 Western states, focused on the acquisition, exploration, evaluation, and the development of battery materials, including lithium, nickel, copper, silver, zinc, and manganese. So with that, let's head over to the UK and talking gold with the one and only Andrew Maguire and our guest today, John Ryan. Over to you, Andy.
Hi, John. It's very nice to meet you.
Andy, very nice meeting you. Thank you for inviting me.
Oh, it's been a pleasure. And in fact, I'm looking forward to the conversation. It's really nice to speak to, the real guys here, the guys that bring it out of the ground. You know what I mean? It's like we sometimes get caught in the ether. And we get, we're trading here, trading there. It's like it's easy to get caught up in the ether, but really nice that you're with us. And I know that Shane's done a bit of an intro there for you, but I understand also you spent some time in active duty in the Navy, and perhaps you could start by telling us what kind of that journey, what attracted you to gold mining, and in fact, Gold Express Mines, where you are now.
Well, yeah, I'll try and give an interesting view on what happened. I grew up, actually. I'm from a mining family. My family's been in mining since the 1870s in Colorado and Leadville, where it started. My father was with American Smelting and Refining, ASARCO, for 40 plus years. Moved from Leadville to Arizona and ultimately ended up in North Idaho, in one of the biggest silver districts in the world, the Coeur d'Alene Mining District, where companies like Hecla and Core Mines and Sunshine and Bunker Hill and all these big names that you might remember or hear about, and of course Hecla and Core being still around, and Sunshine still being out there. But that was the district where there's 1 billion plus ounces of silver production and some of the deepest mines in North America. So I went into mining engineering out of high school at the University of Idaho. And worked summer times and Christmas breaks and things in the mines in North Idaho and in the Coeur d'Alene district. Worked for Hecla and ASARCO both. And then got interested in the Navy towards, I think I was a junior in college. The Navy was recruiting pretty heavily for expanding the Navy. Reagan was in office, so we were going to like a 600 ship Navy at the time. And so, out of college, they were looking for engineering people, and out of college, I had agreed to do a 4-year, stint in the Navy. I went through officer candidate school and then onto a ship stationed in Newport, Rhode Island. Pretty good duty, really. It was a fast frigate, and it was an anti-submarine warfare type ship. So we spent a lot of time in the Atlantic. At that time, the the Cold War was still happening, and there were Russian submarines coming out into the open ocean at that time. And so our job was to try and keep track of those submarines, ballistic submarines, of course, that were armed with strategic weapons, which, we had a lot of interesting times doing that. A lot of it kind of solo ops, not in like a battle group or anything, just on your own with an embarked helicopter and basically chasing submarines. And so then I got out of the Navy in '89 and using up some of my military education benefits, I elected to go to law school up in Boston at Boston College. After that, I decided to move back to Idaho and very quickly kind of got back into the roots of my family and back into mining. So, and mainly in mining exploration and startup mining companies, juniors. I've been doing it since the mid '90s now. So,
it's really interesting.
That's the story there. I really enjoyed the Navy. It was a fantastic experience. Yep.
John, I hope they don't drag you back into the Navy with the Cold War's reinstigated.
Well, I'm hoping I could do a little bit more, be more helpful on the home front. We've got a big need for redevelopment of a lot of our mines and, our own domestic smelting and refining. It's unfortunately been pretty much offshored. And so we have to think about those things. And I think I could probably be more useful there than standing watch on the deck someplace, although I enjoy doing it. I think I'd be more useful elsewhere.
Yes, I agree. So basically, if you could tell us a little bit, it's obviously your mine's name is Gold Express Mines now, but you mentioned silver. So what primarily are you mining and kind of what kind of methods and byproducts would be coming from that?
Well, so Gold Express, just to back up a little bit, I spent 2006. I've had an awful lot of experience in different companies over the years, and maybe I'd just give a quick background on that.
Yes, please.
We picked up a group of us in 2002 had a company, Western Goldfields, so we purchased a mine from Newmont called the Mesquite Mine, and that then was acquired by New Gold, and now that mine belongs to Equinox. And when we picked it up, it was idle, and Newmont had elected to sell it. And since then, got back into production about 2006 at a rate of 175,000 ounces a year, approximately. So you do the math. It's produced a lot of gold since Newmont sold it, and it's still producing. And that was, kind of a little bit of the methodology, let's say, of things that I've done in the past. And 2004, we had a uranium company and sold it to Energy Metals, and that asset, which was in the Powder River Basin of Wyoming, ended up being part of Energy Metals and then part of Uranium One. 2006, going back to my roots in North Idaho, I was part of the team that negotiated the deal to buy the Galena mine and all the North Idaho assets from Coeur d'Alene Mines, and we created a company called U.S. Silver, kept that mine operating, and it's still operating today, part of America Silver, listed on the NYSE American. But more recently, in 2016, I got involved with restarting the Bunker Hill mine in North Idaho, also one of the most famous big lead, zinc, silver mines. And the critical piece there was negotiating a deal with the EPA to clear away all of the, lingering environmental overhang, let's say. So we got a consent decree done in 2018 with the EPA, which really cleared the way to restart the mine. A very talented management team came in 2020. I'd been on the board and also served for a time as interim CEO of the company, but it was time to bring in even more talent. And so there, a group of people, mainly Barrick guys, are now involved in restarting the mine. They've done a tremendous job. They purchased an idle mill from Tech-Cominco and are moving it to Kellogg. It's actually the perfect setup for them, 1,500 ton per day flotation mill. They're driving a big new decline into the mine. But the great thing about that is it's a brownfields asset. Everybody wins. The community wins. State of Idaho wins, the EPA wins because they're getting paid back some of the monies that they expended, taxpayer dollars that they expended on the cleanup. And the nation wins because this is a strategic asset. It was one of the largest lead zinc mines in U.S. history, and it's going to be great to have that one back on board and producing for a lot of different reasons. And so I'm happy to have been a part of that story. So I left Bunker, left the board around mid 2020 or so, and at that time was looking for something new to do. And so myself and my longtime partner, Howard Crosby, formed up Gold Express Mines. And really, it's a multi-commodity company. It's private at the moment. We've raised a fair bit of money privately and acquired quite a few projects around the Western U.S. With a focus on gold. We have some good silver assets. We got a couple of good copper assets, and we even have a uranium asset sitting in the company at the moment. It may not stay there, but the thought here is perhaps spin out some of the assets because we have over 20 property assets in the company at the moment. You can't work on all of them all at once, right? But 4 or 5 key assets. One over in Montana, which is called the Yellow Band Mine. It's near Dillon, Montana. It's a gold property that been drilled multiple times in the past. It's got a decent sized resource, 300,000 ounces of roughly 6 grams. But it's going to be underground. It's been designed as an open pit initially, but we're going to mine that underground. We've got a bulk sample permit in front of the Forest Service right now, which we've worked on for about a year and a half, and hopefully we'll have that permit by the end of the year. And I like it because I think it, has expansion possibilities to as much as, 600,000-700,000 ounces of fairly decent grade. It can be an early cash flow opportunity for the company. So that's our most advanced project at the moment. We're drilling multiple projects. We're just moving a drill right now to a copper project in central Idaho. Part of it on patented ground, part of it on Forest Service ground. Past producer called the Copper Cliff Mine. We think that there's a fairly extensive faulted off portion of the ore body that's underground. That would be an underground mine, not an open pit, but that's what we're drilling. We'll start drilling there in mid-August. That same drill will get shipped down to Arizona. We've got a project down southeast of Kingman. Never been drilled, but big fairway of gold. We collected, there's one major structure running through that it's been faulted a bit here and there, but, we collected a lot of very high grade samples off the surface. And there's some dog holes there, like every mine, there's prospectors that have tried to work it in the past, but nothing, on a commercial scale. So we're going to drill some holes there, not too deep of holes, maybe 300-400 feet deep, maybe a couple that are deeper just to test the continuity at depth. But that one looks like a very interesting possible outcome. It's on Bureau of Land Management ground. We found the permitting there for the drill permit to be very simple and easy, and BLM was very cooperative. We got that done in 2.5 or 3 months. And, if it turns into something bigger, we'll think about where to go process, that ore. So I'm still working on things up in the roots, up in the Coeur d'Alene district. Got a couple of different patented pieces of ground that I've leased up on things that I think, have some potential for further exploration and further discovery. I kind of like these situations where it's not totally grassroots, where you have some information from past work and you try and expand on it. So that's the Gold Express story. We're thinking we'll be public sometime in the early part of next year.
John, I mean, when you've lived and breathed something that you are passionate about, especially, and I think it's almost like an algorithm in your mind. When you see something, you may not be able to even sort of explain it right away, but you just know certain things, and you're very quick to probably to understand, what the potentials or the possibilities are. But I think being us being so involved in the paper to physical war that has been going on for so long, and obviously we're very big on exposing a lot of that. In fact, I just did an episode exposing, really talking about the JP Morgan's thing, where we're talking about spoofing, moving prices around, Fed traders trading, and all, Fed officials trading, all this kind of stuff. But I guess my question is, as somebody who's real, somebody who's in the real physical side of the business, have you been forced to to undertake hedging strategies which probably you wouldn't have normally wanted to do?
Well, right now we're not producing, but certainly when you decide to go finance these projects, right? You're thinking about the risk exposure of declining prices, and mining is once you're in production, you're basically a manufacturing operation, right? And investors, of course, love the upside, the price possible increases on the upside. But you also have to be mindful as a board member or officer of a company, and mindful of your shareholders, particularly if you've taken on debt, that you've got to guard the downside. So yes, when we were at U.S. Silver, for example, we knew that investors didn't like to see silver hedged. So we hedged the lead production, which actually turned out to be a very good move for us. And we only hedged about 30% of the lead production. And then, of course, it turned into a very, very positive thing for us. And everybody said, well, we should have hedged more. But, I don't like to second guess your wins, right? We did well with that. And I think that being involved in a multi-commodity mine maybe gives you the opportunity to hang on to 100% of your silver or gold, because investors do like that, and I understand it, and maybe hedge one of the ultimate commodities that you're producing. Like if you're in a copper gold situation, maybe hedge a portion of that copper production. Same with a lead silver or a zinc lead silver mine. The multi-commodity aspect, I think, is something that sometimes is overlooked, but can be advantageous to an operator. Particularly now, we have strong prices in zinc right now, for example. If Bunker Hill, for example, got themselves into production, and they plan on that in the next year or so, if I were them, if I were still on the team, I would consider strongly putting in a hedge on some zinc production. Why not? Protect the downside for your investors and your shareholders. That happened with U.S. Silver, and there's ways to do it and still maintain a lot of your upside. And you can do these collared hedges as well. You don't lose all your upside on the commodity. So there's a lot of things you can do. And of course I feel like the metal prices, particularly gold and silver, under these conditions that we're seeing today, it's kind of ridiculous seeing these prices where they're at. To me, it's a tremendous buying opportunity. From the perspective of that, this is one of the reasons we've acquired so many projects, frankly, because you see a good project, and if the holding costs are low enough and it's justifiable, it's really just like a call on the commodity. That's how you have to view it, particularly where you have an asset that already has a drilled resource. It's like, it may not have a 43-101, a confirmed resource, but if you've got confidence in the past operator that did the drilling, I don't mind holding on to a couple 100,000 ounce resource for the cost of reclaim fees every year. To me, it's a very cheap hedge. I've explained that to the shareholders of Gold Express, why we have so many properties. They wonder, and I say, well, for example, I'll give you an example. We've got a property in California, which a lot of people don't like California. And, from an operative viewpoint, I get it. I do point out to them that the Mesquite mine was a very smooth transition, and the mine's been producing, since 2006, back in production, and very smoothly been transitioned to a new owner. I think when we purchased it from Newmont, it was a very smooth transition with the state. And California operates. The counties have quite a bit of leeway, quite a bit of power. The county commissioners in San Bernardino County or Imperial County or Sierra County operate, pretty independently. So we've got a project we picked up by staking in Sierra County, which is up near Downeyville, one of the great old mother lode districts, that Kerr McGee drilled back in the late 80s, early 90s with a few 100,000 ounces of resource already drilled. And undoubtedly, we think there's a lot more there that we're holding for, 20 claims at $165 a year. I don't mind tying up a couple 100,000 ounces of resource for $5,000 a year in holding costs, right? So, to me, that makes a lot of sense. One of the reasons we have the number of projects we have is just because we see some resource and some value there just by holding the asset.
It's really interesting to hear you talk because you're providing a hell of a lot of information here. And I think, that was just a simple hedging question, but my goodness me, I understand it's very complex. And I think, as you say, that the interesting thing is when you have these multiple sources of production that are all coming out of one particular, you've got these natural hedging abilities. And I think what's also interesting, because now I'm a firm believer. Yes, you've said also that gold and silver are undervalued, tremendously undervalued. And I think one of the important things that we're focusing on big time is the advent of Basel III legislation, making the over-the-counter market in London, or the over-the-counter markets, actually forcing them to be NSFR compliant. So whereas up until January, 100 to 1, you could play with it, you could just settle gold credit debit positions and play that game. All of a sudden, and people haven't realized this yet, but all of a sudden we're seeing the Bank of International Settlements, the central bank of central banks, actually unloading their leases and swaps. And why are they doing that? Because they're themselves becoming Basel III compliant. And so what that's telling us is that a real supply-demand price that we have not seen since Nixon closed the gold window, what it's done is essentially quietly opened up the gold window, because now I can EFP a COMEX position, I can put it into the over-the-counter market and force T+2 delivery. Okay, I've got to pay a premium, but I can do it. And I think what I'm really leading to is, I see, and we all think, what is the real? We talk to our liquidity providers globally. We've got vaults all over the world. We talk. What's the general consensus? Where do you think the realistic price for gold should be? And the average is around $3,000. I guess my question to you is, what is your break-even price? Average break-even price to produce gold. And what would $3,000 an ounce do to your share price?
Well, I think obviously it would provide a big lift. People would get very excited. But the realities of prices, about a year and a half ago, a friend of mine was talking about putting together, kind of a sophisticated, let's say, financial instrument in the form of a hedge fund, effectively, and wanted to know more about gold. So I did quite a bit of an in-depth study of what operating costs are, cash costs of production in North America, and then full cost, meaning cost plus sustaining cost. And so the average numbers, and this is amongst the majors and some of the mid-level producers and stuff at that time, was around a $1,050 to $1,100 cash cost. And around sort of $1,300 of just full in costs. So when you have a $1,700, $1,800 gold price, it's a $300-$400 delta. If you've got depending on your own cap structure and your cost of capital, it's reasonable, but it's pretty thin. And with recent inflation and supply shortages and so on and so forth, it'll be interesting to see what the numbers are coming out, in terms of cash costs of production of this year. See what's been impacted, and I've got to believe that things are trending quite a bit higher. That that 1050 is now closer to 1150 to 1200, and that all-in sustaining costs are something around 14. And so you are starting to close in on that the fact that the gold price really needs to take a bit of a lift here, or or there are going to be some cutbacks in production. Some of the higher cost mines just aren't going to, unless we see a sustained lift in prices into the more like the $2,000, $2,100 range, I would guess that we'll see some production cutbacks, and that just exasperates but I do think there's a shortage of gold around the world. You probably, I'm quite sure you have a better handle on it than me in terms of actual numbers. But from the operating viewpoint, it's a pretty tight situation on the operating level, I would believe, particularly now with the recent supply shortages and price increases on goods, and there's so many prices on things. This is an interesting talk when you think about inflation, because inflation is as much a mindset as anything, right? And fully 70% of what they publish as the inflation index consists of what they call sticky prices, not flexible prices. So when you think about it, if you're a supplier to the mining industry, for a long time, you're going to wait before you decide to start bumping prices, because you don't want to lose customers. You want to see, are these prices, these supply shortages, a short-term thing, or I can live with for a couple months, or is this something that is more permanent, and then I need to boost prices? But once you get into the boosting prices mode, okay, and you've hiked your prices, and your customers have said, yeah, okay, part of the inflation story, well, you're very reluctant to lower that price again until you see major inventory build, right, and lack of demand. And so once the mindset becomes more like a rising price mindset, other than things like, say, gasoline or things that move are fairly flexible, react quickly, but these durable goods and equipment and things like that, those prices are not going to adjust nearly as rapidly. In people's mindset in terms of where prices are going to be, they're going to have to see a lot of evidence of a softening demand and softening prices before they decide to lower their prices again to their customers. That's just how I see it, but I think that's pretty well known in terms of the economics world, and just common sense would tell you that's how people operate,
Yeah, absolutely. I mean, that makes a great deal of sense. So given what we're experiencing now, we had a black swan event essentially with Russia and Ukraine. Very close to a black swan event, or who knows how that's going to play out after Pelosi went to Taiwan. I mean, there are things that we see from our perspective. We're seeing physical buying. People who are moving in, a lot of our Asian clients, European clients, are buying a lot of physical. We are seeing reference to the Russia trade. We're seeing Indian buyers buying gold, taking a 30% discount on the oil by providing that gold to Russia, and then selling that gold back on the market. It's a very, very, my goodness me, that's a profitable arbitrage trade. And it is, we've seen smuggling, and World Gold Council figures probably 30 tons a month smuggled into India. We think that's almost tripled at this point, because it's a no-brainer trade. But nobody is measuring this suck on supply. And I think what we're seeing here is really a build for a very, very large short squeeze on the paper market. And I think really, when I start to think of silver, and we looked at what happened with nickel, which was basically simply a non-Basel III, obviously, over-the-counter market, which had gone way in excess of where it had been ultimately betting against the rise in price. Now, while silver, and we're seeing all of these things, and of course, silver's joined at the hip with gold, and we're seeing all of these things that are screaming at us. This is underpriced. This is grossly underpriced. No one's really, the paper market has acted like a flywheel, suppressing the price. But as we say, that EFP mechanism is now sucking out the physical, and it's going to our clients And everyone, we know of sovereigns, we know of first-tier banks loading up physical. So I think we're very, very close to seeing a silver enter a nickel-like default, unless something is done, unless the prices allow us to rise. And I think whereas the LME can control, I'm sure you're familiar with the LME and how it operates, but they were able to ring fence that, settled it, no problem at all. But silver's a foreign exchange cross. It is your long silver, short the dollar, long dollar, short silver. So basically, you cannot ring fence it. It is a deliverable product. And so it's going to be interesting. What are your thoughts around that? Do you think silver could go nickel at some point?
Well, I guess the comparison would go back to, what happened with the Hunts, and of course they had several of the sheikhs from Saudi Arabia on their side too, I believe. So they had a tremendous amount of capital and they're buying into a very limited market. And, the example there, I think, when they crushed the Hunts by changing the rules, you probably know it better than I do, but, as I understand it, they changed the rules by basically saying that you couldn't buy a long position unless there was an offsetting short position, I believe, something like that. You probably know it better than me.
Yeah, John, you're right. But the difference there is that they did that in the casino, in the siloed casino of the COMEX.
Mm-hmm.
I mean, so really, where you borrow money off the house, then you take an opposite position against the house, they're going to rinse you 95% of the time. Ultimately, you're going to get rinsed. But in the over-the-counter market, which is global, and I had to get rid of all my US clients in 2013 because they wanted, in fact, they set up this situation where there was so much gold being exiting. So what happened was they literally siloed all US traders to the COMEX only, and any over-the-counter positions they trade are COMEX-centric. So really, what I'm saying here is that the next silver squeeze, if it happens in the foreign exchange markets as opposed to in the COMEX, no one's borrowed any money from the house. And it's interesting because, for example, since they raised the taxes on gold in India, obviously smuggling aside, that's just made smuggling accelerate, but smuggling aside, they've raised the tax on gold. Silver demand, our Indian customers are through the roof. They are buying a lot of silver. So it's be interesting to see, the difference between what happened to the Hunts. I don't think anyone playing in the COMEX sandpit is going to get rinsed. But I think now we're seeing silver so undervalued. Just to me, it's one of these things. And Shane, who introduced you, he just lives and breathes silver. He's going to be soaking up this episode. But it's interesting because what are you seeing on the silver side?
Yeah, if you're a silver miner, it's nice. It would be nice to have control of your own destiny as a silver miner. But for example, U.S. silver, from my experience there, and I've been with the company since 2009, but I'm talking about the historical experience. But the lead concentrate went to Czechomeko, and we got a smelter settlement there, and the copper silver concentrate went to the Horn smelter in Canada, and there's another settlement there. Now, historically, the Sunshine Mine, just down the road from the Galena, it's the number one silver producer in U.S. history and the number two silver producer in U.S. history, and they're about 5 or 6 miles apart. But in the 70s, the Hunts got control of Sunshine through the management then, and they built a silver refinery. Now, why do you think they did that? They wanted control of their own destiny, right? They wanted control of their own destiny. That silver refinery is still there. And, if you have physical yourself at the mine site, you've got a heck of a lot more control over your own destiny and where that gets delivered, right?
Yeah.
And I think that's something that companies need to start thinking about, because there are, as in your discussion, there's clearly, more than one market here operating. It's a bifurcated market. It sounds like becoming more so, where COMEX has just chosen to sort of isolate themselves from the realities of the world and play this paper game, and that's unfortunate. and it penalizes people they're relying upon the price signal coming from COMEX. So, we've got to, we've got to understand how these mechanisms work. As a miner, I mean, you want to have control of your own destiny, I would believe. So it's absolutely brilliant that that the Sunshine is now owned by the Electrum group of companies, or they're the large shareholders, and they've actually got a silver refinery that they could potentially reactivate. And they built it because they had a lot of antimony in the ore, and they were getting penalized by the smelters. One reason, but I think another reason was simply because under the Hunts, they saw what had happened, and they wanted that production to be in the form of physical and not shipping a concentrate off someplace.
Oh, John, you're really encouraging me here, because it's exactly that, to hear someone like yourself say it's the physical. We've got to get control of our physical, and really what you're doing is you're fighting the fight for your whole industry, and it's an industry that's been decimated by the paper market influence, and it's good to hear you talking, because really that's how I think we end all our episodes with, not do you have physical, but how much physical do you own, because it's so important. And I think you're sitting on, as a miner, and the way you're going about it really encourages me.
Well, there's a lot of districts around. I mean, we're focused on the Western U.S. and it's so surprising when you start looking around, because of the new pricing. We've seen some big runs in some of these commodities. With copper prices where they're at, and zinc prices are. When we started working at Bunker Hill, the zinc price was in the 60-70 cent range, and it's, we could make money at that price at Bunker Hill, let alone $1.50 or $1.60, where the numbers have been recently. But this whole regime of really stronger prices, stronger commodity prices, does change the outlook for an awful lot of projects that once were looked at in the Western U.S. What always is amazing to me is to see how well endowed this country was and is. Everything that you needed to build, a very strong economy and a vibrant economy was here. We had great oil supplies, we had great metal supplies, and after several centuries, we still have a lot left. And under this, this stronger commodity prices, if you reevaluate some of these older historic districts, like the Coeur d'Alene district, or like Butte, for example, or like down in Utah, the Tinnick district, an old district that I've looked at carefully and studied. Robert Friedland's in there now, and retransforming that district. It's got a lot left to give. A bunch of districts down in the Arizona area. So what I'm getting at, California, I know California is a little off, a little scary for people in terms of permits, but the Mother Lode has a tremendous amount of gold left. Most of those mines closed in 1942 and never reopened, and they had big reserves on the books at the time. California has 110 million ounces of gold production, only overtaken by Nevada just, a decade or so ago. So we've got a lot of abundance here. We do need some clear pathways to be able to develop it. But we've been blessed, in the United States, with a tremendous resource endowment, which is really where the wealth came from. Let's just be honest about it, right? The West was settled by miners initially. And after that, we had an oil and gas boom that largely, California used to be one of the biggest oil producing states in the country. Some of the largest oil basins ever found were found in California. Go back and look at pictures of Huntington Beach in 1910. There were the oil derricks everywhere. I'm just bringing this up because we do have a lot left, and so there's a lot of value in the ground. And if you can get your mind around that as an investor, that that represents an asset waiting to be developed. I think when I first came into the business in the 90s, because of the big run of inflation that we had in the 70s and into the 80s, and the moves in the metal that were more near at hand, so to speak, investors put more value on assets in the ground. And now the mindset is, okay, there's not a lot of value of assets in the ground if you don't have a clear path to production, so on and so forth. And I get that. I certainly understand that, but also understand that a company, you need to really think about assets in the value in the ground as a major value, particularly in this inflationary environment we're in today, and particularly in light of the fact that we have identified physical assets as being tremendously undervalued, particularly gold and silver, in what's happening out there in the monetary world. So I encourage people to look at, really study a company's, assets, and analysts should be given a little bit more valuation, I believe, to some of these assets in the ground than they're doing currently. So I think they're undervaluing a lot of companies, and that plays itself out in the junior market up in Canada. You can find some very deep value up there right at this moment, and companies that I think are in a few years potentially worth many, many multiples of what they're being valued at today. So it's a great stock picking environment right now.
Obviously, you have obviously a great depth of knowledge here. Can people talk to you? Can they contact you?
Yeah, my email address is jr@goldexpressmines.com, and I'd be happy to have any discussions or make contact with people who have questions or want some advice on or just to learn more about either my company or just learn more about the industry in general. I'm happy to be a resource. Absolutely.
Do you know, I thank you so much for sharing your time with us today.
Well, thank you very much, and thank you for your knowledge. It's encouraging, obviously, to talk with somebody with your expertise and talk a little bit about what's happening in some things that I'm not thoroughly informed about. But I think we're all pointing in the same direction here in terms of the outlook.
We certainly are, and thank you so much for
Thank
your
you.
time.
Take care now.
All right. Thank you so much, Andrew Maguire and John Ryan, for another fascinating discussion. And we want to remind our viewers that we want to hear from you, who you would love to see as a special guest on this show, and to have your say. It's really easy. Just go down to the description below and head over to our Twitter and simply reply to the tweet by tagging your dream Live from the Vault guest, and we'll keep a close eye on the results. And remember, buy physical and understand the difference between what Andy affectionately calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. And there you have it. That's all we have for you today on another episode of Live from the Vault.